The fall of Lehman Brothers. How one weekend killed a 158-year empire. It only took one weekend to bring down a 158-year-old empire. On Monday morning, September 15, 2008, the world woke up to the impossible. Lehman Brothers was gone. The fourth largest investment bank in the United States had filed for bankruptcy, the biggest in American history, with more than $600 billion in assets and $619 billion in debt. Within hours, the markets had a heart attack. The Dow Jones plunged 500 points. Credit markets froze, and what began as a real estate crash turned into a global fight for economic survival. But here's the truth. Lehman's collapse wasn't a black swan. It wasn't unpredictable. It wasn't even surprising. It was the inevitable breakdown of a system redesigned for greed, a system where profit was privatized, risk was socialized, and reality bent to whatever story sold best. Every empire falls the same way, slowly then all at once, and this one began collapsing long before 2008. The beginning, a family empire. Lehman Brothers started in 1850 in Montgomery, Alabama, founded by three Jewish immigrant brothers from Germany, Henry, Emanuel, and Mayer Lehman. They began trading cotton, financing farmers, and connecting the American South to Europe's booming textile industry. Over time, they evolved, from trading goods to financing trade, then to railroads, manufacturing, and finally the great machine of Wall Street capitalism. By the early 20th century, Lehman had survived the Civil War, two World Wars, and the Great Depression. They financed the industries that built modern America: steel, retail, airlines. Lehman was respected, careful, family-run, a symbol of steady capitalism. But the 1980s changed everything, and Lehman changed with it. The age of leverage. The Reagan era unleashed a new gospel: deregulation. The Glass-Steagall Act, which had separated risky speculation from traditional banking since the 1930s, was slowly dismantled. Debt was no longer something to avoid. Debt became a tool. Leverage became the new religion. Borrow cheap, buy big, ride the wave. In this new world, Lehman was reborn, not as a banker but as a gambler. Real estate, bonds, derivatives. If it could make money, they jumped in. Wall Street no longer existed to fund business. It existed to manufacture financial products that made money out of money. The golden age of fake wealth. By the early 2000s, this logic reached its peak: mortgage-backed securities. The idea looked brilliant. Bundle thousands of home loans, sell them to investors, spread the risk. It looked like financial alchemy, turning debt into gold. But the gold was fake. Banks gave mortgages to anyone. No job, no income, no problem. The loans were garbage, but nobody cared. They'd be bundled, stamped with an AAA rating, and sold to pension funds as safe investments. It was a pyramid scheme dressed up as innovation, and Lehman Brothers was one of its architects. By 2007, Lehman was sitting on $600 billion in assets, but only $22 billion in real equity. A leverage ratio of almost 30 to 1. For every dollar they owned, they owed 30. That wasn't investing. It was financial Russian roulette. But markets didn't care. Stocks kept rising, bonuses kept flowing, and the illusion of prosperity grew. Wall Street wasn't measuring risk. It was selling it.